What is good, guys? Welcome back to the channel, and today's topic will be how you can identify high probability key levels, which you then can use to frame your overall trades on a lower time frame based off. So I would say, without further ado, let's get straight into the topic. So first of all, we have to clarify, when does a high probability key level come into play? If you think about the process of framing a setup according to the four-step protocol, then we always have the first step being, that's the wrong thing, the first step always being the trading conditions. So once we are trading in favorable trading conditions, meaning we are most likely to see expansion, then we head over and define our overall higher time frame bias, which could be a daily bias, a weekly bias, all the way down to an hourly bias. So step 2 is determining the bias. Now, once we have gone through those first two filters, the trading conditions and the bias, then we transition to the third step, which is the narrative. Now, narrative is where the key level comes into play. While bias is where price is moving, so pretty much up or either down, narrative is how price is moving according to your bias. So if we know the direction, then the next step is to identify how could price now move from current prices to the level of price where we anticipate price to trade into. And that's, as mentioned, where the key level comes into play. You determine the key level, and then you want to use that key level to frame your trade idea based off. Now that we have cleared that up, what do you always want to look out for key level? The main thing is always you want to have the higher time frame PD array. This can be a daily PD array or an hourly, so an H4 or H1 PD array. All right, that's the main thing. Now, sometimes you have a daily PD array, which you can refine into an H4 and an H1 PD array, and sometimes you might only have an H4, H1 PD array, but those are the main time frames you always want to identify your key level on, to then use that, as mentioned, to wait for price to trade into, and then you can use the M15 or the M5, or sometimes, depending on the setup, even the H1 to frame the trade based off. Then the next thing which a high probability key level should always have is the ability to see a stop run into that key level. What do you mean by that? If we want to see a stop run, we need an old high or low, so a weak high or low, close to the key level, which we then could use for price to run the stops, either buy or sell side, into the key level. So we always want to have a manipulation before we get into a trade into the key level, and then we can look either for a turtle soup entry if the conditions are met for turtle soup trades, or we can look for a lower time frame confirmation once price swept the low and hit the key level. Now let's break it down on the daily, on DXY again as usual, what a daily high probability key level looks like. In the previous videos, I was telling you guys that I do expect DXY trade up into at least this volume imbalance here, which we have done so in the last few weeks. And now, if we check here, what PD arrays has price been responding to? We obviously have this daily imbalance. Let's see here, price almost closed above, but then eventually did not manage to get a candle closure above this imbalance. So price sold off again, and then we take a look at the sell side. What other PD arrays have we disrespected here on this move up? Then our eyes should immediately go to this lower bearish imbalance. We can see here previously, price was using this imbalance to sell off, to trade lower. Then again, later on, price retraced up into that imbalance, swept this daily week high, and then we saw price retracing again lower into this propulsion block here. Daily OB, retrace into the OB, we close above, so this is then a daily propulsion block. So we went from internal stop run into the key level, price retraced into the bullish key level, and again, what do we have here? Stop run into the daily key level. Then once we expanded higher from the daily propulsion block, price then managed to get a closure above this bearish imbalance we previously used as resistance and closed above. So at this point, once we close above, we have an inverse daily fair value gap here. Then as you can see here, in the following up days, once price tapped into the bearish imbalance, then retraced lower, we could then see last week price was using this inverse fair value gap and consolidated inside this fair value gap at the upper half, but then failed to see continuation higher. Now we saw price, as you can see here, this candle here is the Monday range. So if we mark out this Monday range here, we swept the Monday range lows, got then a small expansion higher into Monday mid-range, but failed to then get a continuation into the Monday range highs. Instead, price sold off, and now as you can see, we closed yesterday below the middle of the fair value gap, which already gives you feedback on price, right? Price closing below the middle of a key level, telling you that a key level could potentially fail, right? Doesn't mean it will fail, but the probabilities of seeing it fail become much higher, obviously. Now today's candle still has a bit to go, but as you can see, price most likely will close back below, and then this will be a reclaimed bearish value gap. Also, this swing low here, we most likely will get a closure below that. And as you can see, this gives you already a good idea on the daily what expectations you can have. Where can price move? Where can it retrace into? And those levels you can then refine into H1 and H4 key levels according to what the daily is doing to refine your narrative on an intra-week or intraday level. Now let's drop down to the hourly and see if you can apply the same concepts on the H1. And you always want to keep in mind daily key levels to align them with your H1 key levels, right? You always want to make sure that time frame alignment of the key levels makes sense. So you want to use hourly key levels which align with the narrative of the daily key levels. So we can see here, price trade into daily imbalance, rejected lower, formed this balanced price range here, bullish value gap, overlapped the bearish one, and right below we have this high. Then we swept the high, and at this point our bias is indecisive. Why? Because price pushed higher from this purple zone. Remember, that's the daily inverse value gap. As of now, we're still respecting it. Price pushed higher and the H1 order flow is bullish. Now the question becomes, obviously, will price now continue going higher, head for the buy side here? Or will price respect that hourly bearish BPR here and then head lower? And now that's exactly where the H1 comes into play to validate the higher time frame key levels. So the same thing again, what do we do here? We take a look at the sell side. Then we can see that on the H1 we had this imbalance here. Price retraces, resistance, again resistance, resistance, and price fails to get a closure above. Price rejects from the imbalance, goes for that internal weak low. Then once we swept the low, we got price pushing higher again. And what happened? We have this value gap, which led to the move into those lows, getting inversed again, right here. And then price is pushing higher from here. Now we extend this value gap, which previously acted as resistance. And now if price comes down from external to this value gap here, we don't want to see price to get back below this value gap. This inverse value gap should now hold if we want to see the hourly to be bullish. Now we wait, obviously. If we can engineer a weak low above this key level, something like that. And then if we sweep that weak low into the inverse value gap, then we could look here for our lower time frame setup forming. But now let's say if price retraces here after taking out external and gets back below this inverse value gap and the bullish FVG we have here as well, then this would more likely indicate that price is bearish and is reacting off of that bearish BPR here after sweeping this high into the bearish key level, and we most likely will see price then heading for all of those lows here. So in this case, it's important to monitor how price will react to the key levels on the H1. So we had the last weekly candle closing, I think right here. Yeah, right here we closed the last, here we closed the last weekly candle. And then you can see this week's candle, we opened up below this inverse value gap. And then also this hourly candle closed below the bullish value gap. So in this case, our bias would be to see now price from this inverse value gap to trade into all of those low resistance lows here. Now price is retracing back into the inverse value gap. And now we want to see price using this level as a bearish hourly key level, which validated this daily bearish value gap and stop run into this hourly BPR here, right? I want to see now continuation into those lows. And price takes out the lows. At the same time, we're trading back at that daily inverse value gap. Now again, for a daily key level, we require a daily close to see if the key level gets respected or disrespected. Now that's exactly where we're trading right now. We saw price trading into the key level. Yesterday we still closed inside. Today we'll most likely close below. And again, we still have this daily OB here. So the daily is still indecisive. As mentioned, we are overall here in a consolidation profile. So having a strong directional bias on the daily here is always lower probability. And therefore you want to see, okay, what is the hourly and H4 doing? And then go with the order flow of the hourly. We have this bearish value gap. What happens? Price engineers a weak high, this one. Price runs the weak high in Asia and then expands again into the external, which is the previous day's low. Then price fails to see continuation lower, we reject the lows, retraces back into the fair value gap, but at the same time, price also not able to get it off this high. So right now on the hourly and daily, we are in a tricky situation as price is more or less trapped between opposing daily PD arrays. But as long as the hourly order flow is bearish, we want to stick to bearish DXY, right? Once we flip bullish again, then we can say, okay, the hourly confirmed this daily OB here, and we then can continue to look for bullish DXY. But as long as we respect now this fair value gap, and especially if we close back below this fair value gap and this daily fair value gap, and then have a daily reclaimed fair value gap, we are bearish and want to use this level then to look for lower prices on DXY. And this already concludes today's video. I hope you could take something valuable away from that. If you want to join SCN Capital for the Tune memberships, the signups are open right now. You can find the link below. I would appreciate a comment and a like. And see you guys then in the next one.